Welcome to the Vertical Spread Options Trading channel. My name is Eric, and in this video, I'm going to share some information I've been researching for an SPY price action study. Before we get started, I do want to give a quick shout out to Manny at RN Algo Trading for helping me prepare the spreadsheet you're about to see. He did a great job, and I'm hoping I can explain it in a timely manner. And really what we're going to kind of focus on today is, selling out of the money put spreads on SPY and using real historical data, not just the option pricing data, but actually historical data over 21 years. We're going to get 21 years of consecutive day declines. And what I mean by that is when the market closes down 2, 3, 4 days, 5 days in a row, we're going to look at where the SPY is several days or weeks later, and we're going to do some different combinations of this, which I hope you find pretty interesting. And if you're a put spread seller or a credit spread person, I would think this would be very useful. And we're also going to look at what the percentage of the time the SPY would be higher than that put spread that you're sold. And we're going to kind of focus in on three major time frames: 2 weeks, 30 days, and 45 days out of the money put spreads. And we're going to kind of stick around the Delta 20 put spread option, where we sell the Delta 20 put and we buy one for protection. But we're just going to kind of focus on that Delta 20. And we're going to compare some different days to expiration. And a lot of this is going to make sense in a minute. So let's go ahead and get started. We're going to take a look at this spreadsheet, and we'll jump into the options chain too. Real quick, let me just quickly explain how Manny configured the spreadsheet for me. And we see our time frame. So we're looking at January 1st, 1995, all the way through December 30th, 2016. I'm doing this video in 2017, so I'll probably update the spreadsheet later, but I think this is a pretty good sample set. We have 21 years of daily closes in the SPY, and that's what kind of just looking at daily charts here. So the trigger, or you can use trigger for the term of when we would enter one of these spreads. So if we were to enter on a 2-day sell-off, that would be the trigger. 2 days down in a row. Very simple. The close is lower than the day before 2 times. So a 2-day sell-off, and 14 days later is what we'd be looking at in this example. And we'll talk about the percent of this in a minute. But just real quick, so first thing we're seeing is for the last 21 years, if the SPY closed down 2 days in a row, 14 days later, the SPY would be above the closing bar, that second closing bar, 62% of the time, okay? So again, 2-day close, the close of that second bar, 62% of the time, SPY would be higher than that 14 days later. Okay, but what we want to look at is selling a slightly out of the money put spread. So we actually want to know if the market's going to be higher than a little bit lower of this bar. And for that example, I want to jump into the option chain. If we're looking at 14 days later, now the volatility is really low, and this can vary. And I know my volatility credit spread people are going to, give me thumbs down on this, and that's fine too in the video. Definitely welcome your comments and questions. But real quick, we're going to kind of look around the Delta sort of 20-ish options. So again, in this example, we're looking at 2 days out, 14 days later, or 14 days to expiration. And if we go down about 1%, so right now the SPY as of this video is trading around 255. And again, we're being kind of loose here with our numbers. 255 times 0.99, that is 1% lower. That puts us about 252 and change. So if I come in here, and the 252 strike is about a Delta 23. So again, we're looking at about a Delta 20 option. So if we go into the spreadsheet, and if we, instead of selling an at the money option, we sold an option or a put spread 2 or 1% lower, you can see that the probability, or the likelihood that it closes above that 99% is now over 70%. So let's just go through this again. If the market sells off 2 days in a row, 2 weeks later, 72% of the time, it's going to be above around that Delta 20 strike, okay, or 1% lower. So it's going to be above that. So, I mean, if you sell the out of the money put spread, there's a 72% probability that it's going to stay out of the money in 2 weeks. So I'm using this bar after. This is kind of my days to expiration, and I'm sort of aligning the spreadsheet with delta so that, and the reason why I'm doing that is if you want to take this information and, typically I trade SPX versus SPY because for a host of reasons, but you can, just kind of think, okay, 14 days, I'm still looking at that at delta 20, 2 days later. So hopefully that makes sense. So instead of, let's say that's a little bit too close of a time frame for you, let's just go ahead and look at 30-day options, 30 days expiration. And again, it's about the same, 1% lower. It's about 72% of the time. However, if we go look at the option chain, and in this environment, and this can change obviously with the volatility, a delta 20 is going to be closer to 55 to 2% lower, or about 98% of the current price. So it's going to be about 250. So we look at 250, you can see that that option is closer to delta 20, or even 249. Again, we're just kind of getting close. So now, if I go 30 days out and I change this to 0.98, then we're getting closer to 80%. It's pretty good. 77% of the time, when the market closes 2 days down, 2 days in a row, 30 days later, it's going to be above that delta 20 strike, or 2% lower. So hopefully that makes sense. So before we jump into the next time frame, so let's just look at 3 days lower, right? It's 78% of the time. Let's look at 4 days lower, just kind of, it's about the same, right? 5 days lower, a little bit higher. But the one thing I want you to be aware of is if you waited around for 5-day consecutive, like 5 days down, over the past 21 years, it's very rare that that happens. So we need something that has enough frequency, which is why I kind of want to focus on 2 or 3 days, because there's a lot of 2-day sell-offs. Just think about it, buy the dip is like, full effect. So if you sell on a 2-day sell-off, it's about the same as selling a 4-day sell-off, maybe by 1%. With 30 days expiration. So I just want you to keep that in mind, that it should give you a little bit more confidence that you go ahead and sell that 2-day sell-off. Now, obviously with 4-day sell-offs, the volatility could increase and it's going to move your strikes around and stuff. But again, we're kind of just looking at this framework of history versus time and number of days down and things. So so real quick, let's go ahead before we wrap up the video. Let's look at 45 days to expiration. And the reason why I want to look at this is because the guys over at Tasty Trade talk about 45 days to expiration a lot, and I really value a lot of their information. I'm sure if you're seeing this video, you've seen their videos. Their videos are a little bit higher production than mine, but I wanted to kind of just show that those guys have a lot of good information, and I want to look at just using the same example, using 45 days expiration. So if we go out 45 days here, and we look at 3% lower, again, current environment, 255 times 0.97, we end up at the 247-ish strike, and 247 again, 247.5 is about a delta 20. Okay, so, and I don't know which strikes they like to sell. I think they sell delta 20s too. I don't know. But the point is, with 2-day sell-off, 45 days later, and instead of 98, we're going to do 97, right? It's 80% of the time that your sold strike would still be out of the money. Okay, so let's do a 3-day sell-off. It's about the same. 4-day sell-off. Oops. Sorry. 4-day sell-off, a little bit higher. So again, you don't necessarily have to wait for a 4-day sell-off, and the frequency isn't quite there, but just selling put spreads 45 days out around a delta 20 is a very successful strategy for 21 years. So I hope you enjoyed that video. I'm going to be breaking this down into bear markets and bull markets, and we'll change the percentages. So make sure you subscribe to the channel. I'm also going to be putting out things on IWM and QQQ, and we'll kind of compare those. But again, I hope you enjoyed the video. Be sure to check out the description. I got a couple other studies for you if you're interested, and I'll see you guys in the next video.